It is Sunday night. The futures markets just opened. And right now, in trading rooms from New York to London to Tokyo, the same question is running through every professional investor's mind simultaneously. What exactly do we open to tomorrow morning? Because here's what they know that most ordinary investors do not. This is not a normal Monday. This is not a routine start to a routine week. This is the most convergent, most compressed, most simultaneously dangerous Monday market open in years. And the specific reason it is dangerous is not one thing. It is 6 things. All of them happening at the same time. All of them unresolved as of this Sunday night. All of them with the capacity individually to move markets by multiple percentage points. And all of them arriving together at 9:30 in the morning on Monday, April 13th, 2026, in a single devastating avalanche of uncertainty that Wall Street has been quietly dreading all weekend. Let me walk you through every single one of them, because by the end of this video, you will understand exactly what professional traders are positioning for tonight, exactly what the risk asymmetry looks like for the week ahead, and exactly what you should be thinking about before tomorrow's bell rings. Stay with me. Because every minute you're watching this is a minute you are ahead of the millions of retail investors who will find out what I am about to tell you the hard way at the opening bell tomorrow morning. Let us start with the first and most urgent variable because it towers over everything else happening this week. The Islamabad talks between the United States and Iran. They started Saturday morning, April 11th. As of Sunday evening, the world does not know the outcome. Every institutional trader on the planet is going into Sunday night futures with no confirmed result from Pakistan. Think about what that means for Monday's open. The S&P 500 spent the week of April 7th through April 10th, staging one of its most powerful relief rallies of the year. The index went from below 6,400 to close Friday, April 10th at 6,817.90. That is a recovery of approximately 3.5% in a single week. The Dow turned positive for the year. The Nasdaq posted 7 consecutive days of gains before snapping the streak on Friday. That entire rally was priced on a single assumption: that the Islamabad talks would produce either a framework agreement to continue negotiations or a breakthrough that moves the Strait of Hormuz meaningfully toward full reopening. If the talks produced a credible framework, that assumption is validated and markets could extend the rally further on Monday. But if the talks collapsed, if Iran walked out citing Lebanon, if no agreement was reached and both sides return home with hardened positions, that assumption is immediately repriced. And the repricing of a rally that was built entirely on ceasefire optimism is not gentle. It is sharp and it is fast. A failed Islamabad outcome sends oil back toward $115 to $120 per barrel within hours. It sends S&P futures down 3 to 5% before Monday's open. It triggers the kind of institutional selling that a 7-day relief rally has primed the market for, but has not yet experienced. And as of right now, Sunday night, April 12th, 2026, that outcome is unknown. That is variable number 1. And it is sitting directly beneath Monday's opening bell, like a weight that could go either way. Variable number 2 is Goldman Sachs reporting earnings before Monday's open. And this is not a routine earnings report. Goldman Sachs is the first major bank to report in the Q1 2026 earnings season, which is itself being described by every major financial analyst as the most consequential earnings season since at least 2022. Here's why. The S&P 500 has priced in 13% year-over-year earnings growth for the first quarter of 2026. That is the consensus expectation. It is the 6th consecutive quarter of double-digit earnings growth. And Goldman's report is the first test of whether that consensus is real or whether the March oil shock, which sent Brent crude above $120 per barrel and drove the worst monthly CPI spike since 2022, has already begun destroying corporate margins in ways that earnings models have not fully accounted for. Goldman is expected to report revenues of $16.9 billion for Q1, representing 12% growth from the prior year period. EPS is projected at $16.35, implying 16% growth. Those numbers are strong. But here is what every institutional investor is actually paying attention to. Not the headline Q1 number, which covers January through March when the war had only been running for the final 3 weeks of the quarter. The forward guidance. What does Goldman's management say about Q2? What do they say about what the March oil shock, the 3.3% CPI print, the effectively closed Strait of Hormuz, and the geopolitical uncertainty do to their client activity, their trading revenues, their investment banking pipeline, and their outlook for the second half of the year? The market has priced in a full year of 13% earnings growth. Goldman's forward guidance on Monday morning is the first real-world check on whether that projection survives contact with an economy that is paying 40% more for gasoline than it was 6 weeks ago and running at a monthly inflation rate not seen since 2022. If Goldman guides conservatively, if management signals that Q2 faces meaningful headwinds from elevated energy costs, from credit quality concerns, from the private credit redemption spike that has already seen Carlyle's flagship private credit fund hit redemption requests at 3 times its allowed limit, the market's 13% growth assumption begins to crumble. And when earnings growth assumptions crumble at a Shiller-Cape ratio near 39, the repricing is not measured in tenths of a percentage point. It is measured in multiple percentage points. All of that begins Monday morning, before regular trading hours, with Goldman Sachs' earnings call. Check, verified, urgently relevant. Variable number 3 is the CPI data that dropped Friday, April 10th, and that markets have not fully digested yet over the weekend. Here are the numbers directly. Headline CPI rose 0.9% in a single month. That was above the already elevated consensus estimate of 0.7%, and it was dramatically above the 0.3% monthly increase in February, before the Iran war's oil shock was fully priced into consumer costs. On an annual basis, CPI is running at 3.3% year over year. Energy prices rose 12.5% year over year. The monthly energy spike is the most direct transmission mechanism from the Strait of Hormuz closure to the American consumer's wallet. And the critically important detail is this. The core CPI, which strips out food and energy, came in at 0.2% monthly, below the consensus estimate of 0.3%. That is the good news that allowed markets to close higher on Friday, despite the shocking headline number. Core inflation is being held in check. But here's what every professional trader knows that most retail investors do not. The Federal Reserve does not have the luxury of ignoring headline inflation forever. Chairman Jerome Powell, speaking after the Fed's January meeting, acknowledged the inflation risk from energy, while placing employment and price concerns on equal footing. The Fed held rates at 3.5 to 3.75% at that January meeting and is expected to hold again in May and June. A 79% probability of rates remaining unchanged through the full year of 2026 has been priced into CME FedWatch data. But that pricing was calibrated on oil prices retreating. If the Islamabad talks produce no agreement and oil returns to $115 per barrel, the 79% probability of rates unchanged becomes far more complicated. The Fed cannot cut rates to support a slowing economy while energy prices are driving headline CPI above 3% on a monthly surge of nearly 1%. That policy trap, which Goldman Sachs identified explicitly in its March economic update, does not resolve itself through ceasefire optimism. It resolves itself through actual ceasefire implementation. And Monday morning, before the opening bell, the market does not yet know if actual implementation is coming. Variable number 4 is the Strait of Hormuz status as of Sunday night. As of the most recent data available, only a handful of ships have been transiting the strait daily compared to 129 vessels per day in the pre-war baseline. Goldman Sachs' base case assumed energy flows through the strait would start picking up this weekend following the ceasefire, with a gradual 1-month recovery in Gulf exports to pre-war levels. Under that scenario, Brent crude was projected to average $82 per barrel in Q3 and $80 in Q4. That projection is the foundation of Goldman's year-end S&P 500 target of 7,500. It is the foundation of UBS's revised target of 7,500, trimmed from 7,700 in acknowledgement of the oil risk. And it is the foundation of the S&P 500's current valuation, which is already back to within 1% of its pre-war level of 6,878.88, as CNBC noted Friday. The entire valuation recovery assumes the strait normalizes over 4 weeks. The entire valuation recovery assumes Goldman's baseline scenario of gradual Hormuz reopening plays out. As of Sunday night, the strait has not meaningfully normalized. The strait is still a fraction of its normal capacity. Iran has not issued explicit guidance to global shipping on safe transit conditions. And shipping executives and analysts told CNN this week that uncertainty is still making transit too risky right now for most major shipping companies. You cannot price in a 4-week gradual recovery if week 1 produced less than 10% of normal transit capacity, and the Islamabad talks that were supposed to catalyze the reopening have an unknown outcome as of Sunday evening. The strait is variable 4, and it is directly attached to every other variable in this list. Variable number 5 is the Lebanon situation that ran through the entire weekend, and that directly threatens the survival of the ceasefire framework. You already know the details from the last several days if you have been watching this channel. Israel launched Operation Eternal Darkness on April 8th, killing more than 357 people in a single day. Lebanon and both the United States and Lebanon asked Israel for a pause before Tuesday's scheduled Israel-Lebanon talks at the State Department. Netanyahu had not responded to that request as of Saturday morning. Israeli strikes continued in southern Lebanon on Saturday, April 11th, as the Islamabad talks ran simultaneously. Hezbollah fired rockets into northern Israel in retaliation. If Lebanon explodes further over the weekend, if Netanyahu rejects the pause request, if Iran's delegation in Islamabad use the Lebanon situation as justification to walk out, Monday's open faces an additional geopolitical shock, compounded on top of every other variable already catalogued. The Lebanon variable is not separate from the Islamabad variable. They are the same variable expressed in two different geographic locations. Both resolve or both explode over the same weekend. Both are unknown as of Sunday night, and both arrive at the market simultaneously Monday morning. Variable number 6 is the beginning of Q1 earnings season in full force, and specifically what the banking sector's guidance signals about the second quarter. Goldman Sachs reports Monday, then JP Morgan Chase, Citigroup, and Wells Fargo report Tuesday. Bank of America and Morgan Stanley report Wednesday. All 6 of the largest American banks report in the first 3 trading days of this week. That has never happened before in proximity to the confluence of variables already described. The banking sector entered Q1 earnings season on, as one Yahoo Finance headline put it directly, less certain footing than where they began the year. The KBW Bank Index fell 6% in Q1, marking its worst quarterly performance since the mini-banking crisis of 2023. Private credit funds are experiencing redemption request spikes that are unprecedented outside of the 2008 financial crisis. Carlyle's flagship private credit fund was hit with redemption requests at a rate of 15.7% against a 5% limit. Blue Owl's OCIC fund experienced redemption requests of 29.1%, nearly 6 times its limit. These are not small anomalies. These are signals of institutional stress in the private credit market that the big banks are directly connected to through lending relationships and through their own private credit arms. Howard Marks of Oaktree, one of the most respected voices in credit markets, wrote in a memo this week that the implications of AI for the software industry, limitations on liquidity in private assets, and uncertainty regarding the accuracy of direct lending funds pricing have been there for years, and that people may not have asked enough questions in the good times. That is not a reassuring statement entering an earnings season that is supposed to confirm 13% growth. That is a warning. And it arrives on Monday morning alongside Goldman's report, alongside the Islamabad outcome, alongside the 3.3% CPI data, alongside the not yet normalized Strait of Hormuz, and alongside the Lebanon situation that is still unresolved as of this Sunday night. Now let us put all 6 variables together in the framework that professional traders are using right now to position their Sunday night futures trades. Because understanding the framework is what separates investors who act intelligently in these moments from investors who react emotionally and pay the highest possible price for that reaction. The market, as of Friday's close at 6,817.90, has priced in an optimistic middle scenario. Call it the Goldilocks ceasefire scenario. The Islamabad talks produce a framework agreement, not a collapse, not a breakthrough. Iran partially cooperates on the Strait. Lebanon's situation stays contained, and the Tuesday Washington talks produce some dialogue. Goldman Sachs reports numbers in line with or above consensus and guides cautiously but not alarmingly for Q2. CPI's headline shock is dismissed as energy-driven, and core inflation's relative tame reading provides cover for the Fed to stay on hold. In the Goldilocks scenario, Monday opens flat to modestly higher. The relief rally continues slowly, and the market grinds toward Goldman's 7,500 year-end target over the back half of the year. But here is what the Goldilocks scenario requires that the market has already priced in and that the current reality has not yet confirmed. It requires the Strait to begin opening. It requires the Islamabad talks to produce something. It requires Goldman's forward guidance not to shock. It requires Lebanon not to escalate. And it requires the private credit redemption situation not to become systemic. Every single one of those requirements is binary. Either it delivers or it does not, and the asymmetry of outcome is stark. In the positive scenario, the market extends a rally it has already largely completed, gaining perhaps another 2 to 3% from current levels. In the negative scenario, the market reverses the entire relief rally it staged this week, losing 3 to 7% from current levels, as the assumption that drove the 7-day winning streak is invalidated by reality. The risk-reward for a long position entering Monday is unfavorable. The upside is limited because the good news is already priced. The downside is large because the bad news has not been priced. That asymmetry is why the word terrified is not an exaggeration when describing how Sunday night trading desks feel about tomorrow's open. Let me show you 3 historical case studies where this exact Sunday night to Monday morning dynamic produced exactly the outcome that markets feared. Because history rhymes, and understanding the historical pattern is what separates sophisticated market analysis from opinion. The first case study is Sunday, October 6th, 2019. U.S.-China trade talks were scheduled to resume the following week. Markets had staged a relief rally on positive signals. Sunday night, the Trump administration placed Chinese companies on the entity list unexpectedly over the weekend. Monday's open fell 2% in the first 30 minutes. The pattern was identical. Relief rally priced in positive outcome. Surprise, negative development over the weekend. Monday open repriced the rally. The second case study is Sunday, March 8th, 2020. Oil markets collapsed over the weekend as Saudi Arabia and Russia launched a price war simultaneously with the early COVID-19 shock. U.S. markets had tried to rally the prior week on hopes that the COVID-19 situation would remain contained. Sunday night futures fell 7% before circuit breakers were activated. Monday opened at circuit breaker levels. Everything priced in the prior week's optimism was wiped out before the bell. The third case study is Sunday, February 27th, 2022. Russia invaded Ukraine over the weekend. Markets had been pricing in diplomatic resolution through the final week of February. Sunday night, as the invasion became real, futures collapsed. Monday opened with enormous volatility. The relief rally that had built on diplomatic hopes was reversed in a single session. Three cases, same dynamic. Relief rally built on positive expectation. Weekend development fails to confirm that expectation. Monday open reprices sharply downward. The reason this case study framework matters right now is that the Sunday night dynamic of April 12th, 2026 is structurally the most similar to these three cases of any Sunday night in recent memory. A relief rally built on ceasefire optimism, weekend talks of uncertain outcome, Monday open with no confirmed positive result. The historical base rate of Monday openings downward in this configuration is high. But there is an additional layer to this specific Monday that was not present in the 2019, 2020, or 2022 Sunday night shocks. In all three of those cases, the market entered the dangerous Sunday night having recently experienced a drawdown. Investors were already positioned cautiously. In the current case, the market enters Sunday night having just staged a 7-day winning streak and recovered to within 1% of its pre-war level. Investor optimism has been rebuilt. Retail buying has returned. The short squeeze has run its course, and the market is now sitting in exactly the kind of elevated sentiment position that the IO Fund analysis, published in February of 2026, identified as one of the most reliable precursors to significant corrections. The No IM readings, which track professional money manager stock exposure, were ranging between the 78th and 96th percentile of all bullish readings before the Iran war began. The war knocked sentiment back sharply. And then the 7-day relief rally rebuilt it partially. The investors who are most exposed to Monday morning's shock are the ones who bought back into the market during the week of April 7th through April 10th, adding exposure on the ceasefire optimism, buying the relief rally, unwinding their hedges as the VIX fell, and positioning for the continued recovery that the Islamabad talks were supposed to confirm. Those investors are now fully loaded into a market whose catalyst for continuation is unconfirmed as of Sunday night. That positioning dynamic, heavy buying at the top of a relief rally just before a binary outcome is resolved, is the most dangerous investor position in the short-term trading universe. And it describes where a significant portion of the retail investor base sits right now as Sunday night futures trading begins. Let us also be specific about what the earnings season beginning this week means for the market's longer-term trajectory, because the 6 banks reporting Monday through Wednesday are not just Q1 reporters. They are Q2 guides. And Q2 guidance is what the market has not yet been forced to confront. The S&P 500's 13% earnings growth consensus was constructed before the March oil shock drove energy prices to their highest levels in years, before inflation posted its worst monthly reading since 2022, before the Strait of Hormuz was effectively closed for 6 weeks, and before Delta's CEO publicly announced meaningful capacity reductions due to jet fuel costs. Every one of those developments is a Q2 headwind that was not in the original 13% growth model. And the first systematic look at how companies are thinking about Q2 happens when Jamie Dimon, Lloyd Blankfein's successor, David Solomon at Goldman, and Jane Fraser at Citigroup sit down on their earnings, calls Monday through Tuesday, and answer analyst questions about how the oil shock is affecting their clients, their loan books, their trading revenues, and their outlook for the second half of the year. This matters beyond just what the banks say about themselves. The banks are the intermediaries of the entire economy. When Jamie Dimon describes the health of JP Morgan's commercial lending book, he is describing the health of every American business that borrows money. When he describes what clients in the energy sector are telling him, he is describing the pass-through of the oil shock to corporate margins. When he describes what consumer credit quality looks like in March versus January, he is describing whether the 40% gas price increase and the 0.9% monthly CPI reading are flowing into household financial stress. All of that information arrives Tuesday morning. And it arrives on the same morning that the Islamabad framework is either confirmed or collapsing, that Lebanon's situation is either stabilizing or escalating, and that the Strait of Hormuz is either showing signs of normalization or sitting at less than 10% of its normal capacity for the 7th day in a row. The week of April 13th through April 17th is not a week where any single piece of information is more important than the others. It is a week where all of the information arrives simultaneously and reinforces or undermines a single central question. Was the relief rally justified by the reality that is now being revealed? That question does not have a gentle answer. Either the reality confirms the rally, in which case the market has room to continue, or the reality contradicts the rally, in which case the market has to give back what it built on an assumption that turned out to be wrong. And as of Sunday night, the reality has not yet been confirmed. Now let us talk about what the specific indicators will tell you within the first few minutes of Sunday night futures trading, whether Monday's open will be positive, flat, or sharply negative. Because this is the most practical information in this video, and it is the information that professional traders are monitoring right now at this very moment. The first indicator is the price of Brent crude oil in Sunday night trading. If Brent opens Sunday night below $95 per barrel, it is signaling that whatever outcome came from Islamabad was at least marginally positive, and markets are pricing in partial strait reopening. If Brent opens Sunday night above $100 per barrel and rising, it is signaling that the Islamabad talks produced nothing positive and the strait remains effectively closed. As of Friday's close, Brent was trading around $95 to $97 per barrel, already elevated despite the week's relief rally. The direction of crude Sunday night is the most direct, most real-time indicator of what happened in that Islamabad hotel room. The second indicator is the 10-year Treasury yield. If Treasuries are being bought in Sunday night trading, meaning yields are falling, that is a risk-off signal. Investors selling equities and buying the safety of government bonds signals fear about Monday's open. If Treasury yields are rising or flat, that is closer to risk-neutral positioning. The third indicator is the VIX, Wall Street's fear gauge. The VIX touched above 27 during the most volatile moments of the April Iran escalation. It came down substantially during the relief rally. If the VIX begins rising Sunday night above 20, that is institutional positioning for Monday morning volatility. If it stays below 18, the market is treating the weekend as manageable. These three indicators, crude price direction, Treasury yield direction, and VIX level, give you the real-time market verdict on the Islamabad outcome before any official announcement. Professional traders read them within the first 30 minutes of Sunday night futures trading. Now you know to do the same. Here is what the week ahead actually looks like in terms of what has to go right versus what has to go wrong for the market to either extend the relief rally or give it all back. For Monday to be positive, Goldman Sachs must report numbers at or above consensus, guide for Q2 in language that does not alarm on energy cost headwinds, and the Islamabad talks must have produced at least a framework agreement with some signal of straight progress, with Lebanon not having exploded over the weekend. That is a two-variable conjunction. Both must be true. For Monday to be flat to negative, either Goldman's guidance disappoints or the Islamabad talks produced no agreement. Only one of the two must fail. For Monday to be sharply negative, both Goldman disappoints and the Islamabad talks collapsed with no agreement, Iran walking out, Lebanon bombing intensified, and the Strait signaling no near-term reopening. The probability distribution over those three outcomes, given the available information as of Sunday night, is not symmetrical. The conjunction required for a positive open is harder to achieve than the individual failure modes required for a flat to negative open. And that asymmetry is why Wall Street's institutional money is terrified of tomorrow morning, in a way that the 7-day relief rally did not price. There is one more element that has not received sufficient attention in the coverage of this week's market setup, and it belongs in this analysis because it directly connects to the bank earnings that arrive Monday through Wednesday. Delta Airlines CEO Ed Bastian issued a warning this week that the carrier will meaningfully reduce near-term capacity growth plans due to rising jet fuel costs. That warning did not come from a small regional carrier. It came from the CEO of one of America's largest airlines. And what Delta's CEO said about jet fuel is what every company in America's consumer-facing economy is dealing with, but has not yet publicly disclosed. The oil shock from the Strait of Hormuz closure has been running for 6 weeks. The S&P 500's Q1 earnings cover January through March. The oil shock escalated most severely from late February through March. Many companies finalized Q1 before the full impact hit their cost structures. Q2 is the first quarter that will fully absorb the oil shock costs. And the bank earnings arriving Monday through Wednesday will contain the first systematic disclosures of what corporate clients are telling their bankers about Q2 cost pressures. Delta was willing to say it publicly and immediately. Most companies have not yet had an earnings call to do so. JP Morgan's Jamie Dimon, reporting Tuesday, has the most comprehensive view of the American corporate landscape of any single CEO in the country. What he says about Q2 corporate health on Tuesday morning could be the most consequential single statement about the American economy made in the next 30 days. And it arrives on Tuesday, one trading day after Goldman's Monday report. In a week where the Strait is still functionally closed, Lebanon is still being bombed, the Islamabad result is unknown as of Sunday night, and the CPI data from Friday is still sitting in the market's consciousness at 0.9% for a single month. Let me also address the specific technical picture of the S&P 500 because the technical reality compounds the fundamental reality in a way that makes Monday's open even more dangerous for unprepared investors. The S&P 500 is currently sitting within 1% of its pre-war level of 6,878.88. It got there in 7 trading days on a relief rally. The Barclays strategy team noted this week that the rebound has been driven in part by a powerful short squeeze as bearish bets were unwound into the rally. What that means in plain language is that a significant portion of the week's gains were generated by investors who had bet against the market being forced to cover those bets as the market moved against them. Short squeezes produce sharp, fast rallies. They also produce sharp, fast reversals when the mechanical buying is exhausted. The S&P 500 is still below its 200-day moving average of 6,647, according to Schwab Center for Financial Research data. A market that rallied nearly 400 points in a week while still sitting below its 200-day moving average has not technically confirmed a new uptrend. It has produced a powerful relief bounce within an ongoing downtrend. The difference between those two descriptions is the difference between buying the breakout and buying the dead cat bounce. And the resolution of that technical ambiguity happens, not coincidentally, on the same week that Goldman reports, JP Morgan reports, the Islamabad outcome becomes known, and the CPI data is sitting fresh in the market's memory. Every technical and fundamental variable in this market is converging on the same week, on the same Monday, on the same opening bell. Here's the bottom line. Here's what you actually need to know when you put your phone down after watching this video. The S&P 500 closed Friday at 6,817.90, having staged a 7-day rally that assumed a positive weekend. The weekend that was assumed to be positive contains a set of unknowns that could reverse that assumption before Monday's first trade is executed. The Islamabad talks outcome is unknown. Goldman Sachs' forward guidance is unknown. Lebanon's trajectory over the weekend is unknown. The Strait of Hormuz's Sunday night traffic data is available, and it is the most direct indicator of everything else. Watch it. Watch Brent crude Sunday night. Watch the VIX. And understand that the relief rally that ran from 6,350 to 6,817 on ceasefire optimism was a bet on a positive weekend outcome. If the weekend outcome is positive, you are right, and the market continues. If the weekend outcome is negative, the entire week's gains are immediately at risk, and professional money is positioned to capture that reversal before retail investors have the information to respond. That is what Wall Street is terrified of tomorrow morning. Not any single variable. The confluence of all of them, simultaneously, at 9:30 a.m. Eastern Time, Monday, April 13th, 2026. There's one final element of this Sunday night picture that belongs in this analysis because it is the variable that institutional traders are treating as the wild card above all others, and it connects directly to everything already discussed. The private credit market stress. In the week ending April 10th, 2026, Carlyle's flagship private credit fund was hit with redemption requests at a rate of 15.7%, 3 times above its 5% limit. Blue Owl's primary fund, OCIC, received redemption requests of 29.1%, nearly 6 times its 5% cap. These are not small funds. Carlyle's tactical private credit fund holds $7 billion in assets. Blue Owl's OCIC is one of the largest private credit vehicles in the market. When institutional investors are trying to exit private credit funds at 6 times the allowed rate, something in the underlying credit quality assessment has shifted. Howard Marks of Oaktree captured the concern precisely in his recent memo when he said that limitations on liquidity in private assets and uncertainty regarding the accuracy of direct lending funds pricing have been there for years, and that people may not have asked enough questions in the good times. What he is describing is the possibility that private credit valuations, which are marked to model rather than to market because the underlying loans are not publicly traded, have been carrying values that do not reflect the actual stress in the underlying borrower base. And that stress has been growing for 6 weeks under the weight of 40% higher energy costs, a 3.3% CPI reading, and a Federal Reserve that cannot cut rates to provide relief. The big bank earnings arriving Monday through Wednesday will be the first time that JP Morgan, Goldman, Bank of America, and their peers are forced to publicly characterize what they see in the private credit adjacent parts of their portfolios, what their commercial banking clients are telling them about Q2 borrowing conditions, and whether the private credit redemption spike is an isolated event or a leading indicator of broader credit stress. If even one of the major bank CEOs Tuesday signals concern about credit quality deterioration, the private credit redemption story moves from a specialized financial media story to a mainstream market narrative, and a mainstream market narrative about credit quality deterioration, arriving simultaneously with geopolitical uncertainty from the Islamabad talks, arriving simultaneously with the worst monthly CPI reading since 2022, arriving simultaneously with the Lebanon situation threatening the ceasefire, is the specific combination that turns a manageable market correction into something that moves markets by more than manageable amounts. That is the tail risk sitting inside Monday's open that the 7-day relief rally did not price. Not the most likely outcome, but the outcome where every individual risk variable amplifies every other individual risk variable in the same direction simultaneously. And that kind of tail risk does not announce itself. It arrives at the opening bell and forces everyone to reprice at the same moment. Subscribe right now and turn on every notification, because tomorrow morning when that bell rings, we will be here with the real-time breakdown of everything that hits simultaneously. Goldman's report, the Islamabad outcome, Brent crude, the VIX, the Lebanon update, all of it, the moment it matters most, tomorrow morning. Do not miss it. One final thought before you go. The most dangerous investing mistake in a moment like this is assuming that because the market staged a 7-day relief rally, the danger has passed. The danger has not passed. The danger has been temporarily deferred while markets waited for the weekend to resolve the variables that the rally was built on. Those variables are resolving right now, on Sunday night, in the oil futures price, in the VEX level, in whatever statement eventually comes from Islamabad and from whatever Netanyahu decides about pausing Lebanon before Tuesday. The market told you last week what it wanted to hear. This week it gets told what is actually true. That difference between what the market wanted and what is actually true is precisely where money is made and lost at the opening bell. You know both sides of that equation now, positioned accordingly.